You can avoid common pitfalls and seize opportunities that others might miss. It's about being proactive rather than reactive, and positioning yourself for long-term success. You can then maximize your returns and minimize potential losses. A well-informed investor can adjust their portfolio to mitigate risks and capitalize on growth opportunities. This strategic approach can lead to more consistent and sustainable returns over time. Think of it like checking the weather before a trip. Just as you wouldn't head out on a journey without knowing the forecast, you shouldn't invest without understanding market trends. This preparation can help you avoid unpleasant surprises and make the most of favorable conditions. If you know a storm is coming, you pack an umbrella. Similarly, if you anticipate a market downturn, you can take steps to protect your investments. This might involve reallocating assets, increasing cash reserves, or seeking out more stable investment options. In the same way, understanding market trends helps you prepare for what's ahead. By staying informed and adaptable, you can navigate the market's ups and downs with confidence. This proactive approach can help you achieve your financial goals and build a more secure future. You can adjust your investment strategy accordingly. Whether it's reallocating your assets, diversifying your portfolio, or simply staying the course, understanding market trends empowers you to make strategic decisions that align with your financial objectives. So, buckle up and let's dive into the current market landscape and what we might expect in 2025. By examining current trends and projections, we can gain valuable insights into potential opportunities and challenges that lie ahead. Remember, knowledge is power, especially in the world of investing. The more you understand about market trends, the better equipped you'll be to make informed decisions and achieve your financial goals. So, let's get started on this journey together. At play will be crucial for investors navigating the year ahead. While the U.S. market has shown resilience, some dark clouds are gathering. Despite the recent bullish trends, there are several indicators that suggest potential underperformance in the near future. Investors and analysts alike are beginning to question the sustainability of the current market conditions. One major concern is the high valuations of many stocks. Over the past few years, we've seen stock prices soar to unprecedented levels, driven by a combination of low interest rates and abundant liquidity. However, these high valuations raise the question, are these prices justified by the underlying earnings and growth prospects of these companies? Or are we witnessing a speculative bubble that could burst at any moment? Are these prices justified by earnings and growth prospects? Or are we in a bubble on the verge of bursting? The fear of a market correction looms large, as history has shown that periods of rapid price increases are often followed by sharp declines. Investors must tread carefully, balancing the potential for gains with the risk of significant losses. Another factor is the shift in monetary policy. The Federal Reserve, which has been a key player in supporting the market through its accommodative policies, is now signaling a change in direction. The era of easy money appears to be coming to an end, and this shift could have profound implications for the market. The Federal Reserve's aggressive interest rate hikes are designed to tame inflation. While controlling inflation is crucial for long-term economic stability, higher interest rates can also lead to increased borrowing costs for businesses and consumers. This, in turn, can dampen economic activity and slow down growth. However, they also increase borrowing costs for businesses. Companies that have relied on cheap credit to finance their operations and expansion may find themselves under pressure. Higher borrowing costs can squeeze profit margins, leading to reduced investment and potentially even layoffs. This can slow down economic growth, potentially impacting corporate profits. As businesses face higher costs and reduced consumer spending, their earnings may take a hit. This could lead to a downward revision of profit forecasts, further weighing on stock prices. Market concentration is another issue. The stock market's performance has become increasingly reliant on a handful of mega-cap tech companies. These giants have driven much of the market's gains, but this concentration also means that any trouble in these companies can have outsized effects on the broader market. A handful of mega-cap tech companies have an outsized influence on major indices. Companies like Apple, Amazon, and Microsoft hold significant weight in the market, and their performance can sway the direction of indices like the S&P 500 and Nasdaq. If these companies stumble, the entire market could feel the effects. We've seen this happen before, where a poor earnings report or negative news from a major tech company leads to a broader market sell-off. The risk of such events remains ever present. We saw this happen in 2022, and it's a risk that persists. The market's heavy reliance on a few key players makes it vulnerable to shocks. Diversification is essential, but even a well-diversified portfolio can be affected by significant market movements. Finally, geopolitical uncertainty always looms. The global political landscape is fraught with tensions and conflicts that can impact markets. From trade wars to military conflicts, these events can create volatility and uncertainty. The ongoing war in Ukraine, tensions with China, and other global events can create volatility in the markets. These geopolitical risks can lead to sudden shifts in investor sentiment, causing rapid market movements that are difficult to predict. Investors need to be prepared for unexpected shocks that could send ripples across the globe. Staying informed, diversifying investments, and having a long-term perspective are key strategies to navigate these uncertain times. While the market may face headwinds, prudent planning and risk management can help investors weather the storm. Section 4. The Economic Crystal Ball: GDP, Inflation, and Jobs in 2025. Predicting the future is never easy, but economists have their ways. They use a combination of historical data, current trends, and sophisticated models to make educated guesses about what lies ahead. While these predictions are never foolproof, they provide valuable insights that help businesses, policymakers, and individuals make informed decisions. Current projections for 2025 paint a somewhat mixed picture of the U.S. economy. On one hand, there are signs of stability and growth, but on the other, there are potential challenges that could disrupt this balance. Economists are closely monitoring various indicators to gauge the overall health of the economy. GDP growth is expected to be modest, likely hovering around 2%. This rate of growth, while not spectacular, indicates a steady expansion of the economy. It suggests that businesses are continuing to invest and consumers are spending, albeit at a more cautious pace. This is below the long-term average and suggests a slowing but not stalling economy. Historically, the U.S. has seen higher growth rates, but various factors such as global economic conditions, domestic policies, and technological advancements play a role in shaping these numbers. Inflation is the wild card. It's the unpredictable element that can have wide-ranging effects on the economy. When inflation rises too quickly, it erodes purchasing power and can lead to higher interest rates, which in turn can slow down economic growth. While it has shown signs of cooling, it remains above the Federal Reserve's 2% target. This persistent inflation is a cause for concern as it affects everything from the cost of groceries to the price of housing. The Federal Reserve has a challenging task of balancing inflation control with economic growth. The big question is whether inflation will continue to moderate or prove stickier than anticipated. If inflation remains high, it could force the Federal Reserve to implement more aggressive measures, such as raising interest rates, which could have a cooling effect on the economy. This will have significant implications for interest rates, and consequently, the stock market. Higher interest rates can make borrowing more expensive, which can slow down business investments and consumer spending. This, in turn, can lead to volatility in the stock market as investors react to changing economic conditions. The labor market is expected to remain relatively strong. Despite the challenges posed by inflation and potential interest rate hikes, the demand for workers continues to be robust. This is a positive sign as it indicates that businesses are still growing and need more employees to support their operations. Unemployment is projected to stay near historic lows, indicating a healthy demand for workers. This low unemployment rate is beneficial for workers as it often leads to better job security and opportunities for wage growth. However, wage growth is likely to moderate as inflation cools, potentially impacting consumer spending. When wages grow at a slower pace, it can affect how much consumers are willing and able to spend, which in turn can influence overall economic growth. In summary, the economic outlook for 2025 is one of cautious optimism. While there are positive signs such as strong employment and steady GDP growth, there are also challenges like persistent inflation that need to be addressed. Growth is expected to be moderate, inflation remains a concern, and the labor market looks solid. These factors combined paint a picture of an economy that is resilient but facing headwinds that need careful management. Investors should keep a close eye on these indicators as the year progresses. By staying informed and adaptable, they can navigate the complexities of the economic landscape and make strategic decisions that align with their financial goals. Section 5. Bulls versus Bears. Wall Street's divided outlook for 2025. As always, Wall Street is a battleground of opinions. Bullish analysts believe the U.S. market can still deliver solid returns in 2025. They point to the resilient economy, strong corporate earnings, and the potential for innovation to drive growth. Some even see the recent market dip as a buying opportunity. On the other hand, bearish analysts are more cautious. They worry about high valuations, rising interest rates, and the potential for a recession. They argue that the market has not yet fully priced in these risks and that a correction is overdue. Who's right? Only time will tell. The reality is that predicting the market with certainty is impossible. Both bulls and bears make valid points. Investors should consider both perspectives and form their own conclusions based on their risk tolerance and investment goals.